Hello and welcome. This is from the CBN. We bring to you weekly reports and expert analysis of the actions, policies and economic initiatives of the Central Bank of Nigeria, CBN. I'm Williamisi Dada. Days leading up to the May meeting of the Central Bank of Nigeria's Monetary Policy Committee, economic analysts had rightly predicted that the committee would raise the benchmark interest rate from the 11.5% it had retained for more than 2 years, due in part to the recent data released by the National Bureau of Statistics, which showed an increase in headline inflation for the third consecutive time. But it would have been hard to correctly predict the 150 basis points jump that 6 of the committee members decided upon. In this episode, we bring to you the who, what, why and how of the May meeting of the MPC, plus highlights of the 2022 CBN Senior Tennis Championship, which held over the weekend in Abuja. We'll begin right after this break. Stay with us.
North, South, East or West, male or female, old school or millennial, rural or urban, the Naira is the same, and so is the e-Naira. The e-Naira is a legal tender issued by the Central Bank of Nigeria. So, let's embrace it. The e-Naira will foster financial inclusion, improve access to credit, facilitate cross-border remittances, and it's easier to transfer. E-Naira, same Naira, more possibilities. This message is from the Central Bank of Nigeria, CBN.
Confronted with declining growth around the world and heightened uncertainties on account of the ongoing war in Ukraine, sanctions imposed on Russia, and the lingering impact of the COVID-19 pandemic on Chinese economy, central banks in both advanced economy and emerging market economy are switching to monetary tightening to curb the sharp rise in inflation globally. While the domestic economy is expected to remain on the current recovery path through the year based on the continued impact of the stimulus by the monetary and fiscal authorities to support the economy following the outbreak of the COVID-19 pandemic, the 11 MPC members present at the May meeting assessed this development and the outlook for the rest of the year.
Inflation continued to rise unabated across several advanced economies and is projected to remain high, at least in the medium term, as food and energy prices pushed higher to levels not previously recorded in 4 decades. This is due to tightening supply amidst closure of major trade routes that supply input for food and fertilizer, as well as high price of energy. In the emerging market and developing economies, inflation also remained high due to a combination of persisting high food and energy prices, supply chain disruptions associated with the impact of the sanctions against Russia, exchange rate pressure, capital flow reversals, as well as underlying legacy matters. In the global financial market, investor confidence is gradually being restored, evidenced by portfolio rebalancing with the gradual decline in gold price. The demand for advanced economic equities and bonds has improved with the commencement of interest rate liftoff, led by the US Fed and the Bank of England, resulting in the outflow of capital from emerging market securities. Global financial conditions are thus expected to tighten in the near term as risk-averse investors reassign substantial portions of their portfolios from perceived riskier, though more rewarding emerging market securities, to less risky advanced economy securities. In general, the global economy and financial markets are confronted with significant risks in the medium term as the huge buildup of both private and public debt may push several fragile economies into a new era of recession. The broad outlook for both the global and domestic economies in the medium term remain clouded with uncertainties arising from the lingering war between Russia and Ukraine, the unfolding impact of the extensive sanctions imposed by several countries on Russia, and the downside risks from the continued spread of COVID-19 pandemic. Global growth is thus confronted with significant headwinds, which may derail the current projection further. The persistent rise in inflation is also set to undermine the recovery of output growth due to the associated buildup of uncertainties around the cost of inventory and other production inputs. The rise in global debt is also an unfolding dilemma which policymakers must carefully evaluate and address to avert a near-term global financial crisis. In summary, while global aggregate demand remains strong and growing, the numerous supply-side constraints will continue to undermine the recovery effort, at least in the short to medium term. In the domestic economy, data on key macroeconomic variables indicate that the recovery of output growth will continue, but at a much subdued pace, considering the unfolding domestic and external shocks to our economy. Domestic price development is, however, expected to maintain an upward pressure in the light of the buildup of increased spending related to the 2023 general elections. Consequently, the Nigerian economy is forecast to grow by 3.24% by the CBN estimate, 4.2% Federal Government of Nigeria estimate, and 3.4% IMF estimate.
Concerned about the aggressive rise in inflation in the country, the MPC decided to shift from its cautious approach on interest rates to a policy rate hike. It, however, continues with the accommodative approach to development finance initiatives, leaving the rates on its various intervention schemes at 5% till next year March. As regards the decision on whether to hold, tighten or loosen the monetary policy rate, the committee felt that loosening may result in a sharp rise in capital outflow and faster dry-up of foreign credit lines. Loosening could also lead to further liquidity surfeit and inflationary pressure. The committee believed that tightening the interest rate would help rein in inflation before it assumes a galloping trend, narrow the negative real interest rate margin, improve market sentiment, and restore investor confidence.
Members expressed deep concern about the continued uptrend of inflationary pressure. Despite the gradual improvement in output growth, the committee noted that the current rise in inflation may be inimical to growth and thus hinder the full recovery of the Nigerian economy. While MPC identifies several supply-side factors which may be contributing to inflationary pressure, emerging evidence show that money demand pressure is on the rise and is unlikely to abate until the 2020 general elections are over. The dilemma confronting the monetary policy at this meeting, therefore, is how best to drive down domestic prices, in this case inflation, while at the same time continue to support the fragile recovery of the Nigerian economy. In the light of the current circumstance, the committee was of the view that it was confronted with the choice of either to hold all policy parameters constant, to allow previous policy measures continue to support growth, or tighten the stance of policy to curb money demand growth and development of its domestic prices. A loosening option would likely result in an increased liquidity surfeit, rise in inflationary pressure, and further pressure on our exchange rate. The choice of holding, in the view of members, would not only continue to support growth, even though moderately, but will also allow the growth of money's demand to continue at the current pace, leading to the uptick in inflationary pressure. While growth concerns remain paramount to the committee, the persistent uptick in domestic price levels is clearly a downside risk to growth that must be taken on immediately. While it may seem contradictory to raise rates in the face of fragile growth, it is a dilemma that most central banks around the world today are grappling with at this time. Yet, on balance, it is quite clear and compelling that tackling inflation is more urgent in the sequence of policy objectives. In this regard, MPC urged the bank to redouble its efforts at supporting the priority growth-enhancing sectors of the economy, while urging the federal government to do more to provide a safe and secure environment for economic agents to boost activities and eventually stimulate growth. After carefully reviewing the developments of the last 2 months and outlook for both the domestic and global economies, as well as the benefits and downsides of each policy option, the committee decided to raise monetary policy rate, the first in 2.5 years, to rein in the current rise in inflation, as members were of the view that the continued uptrend may adversely impact growth. The bank further reaffirmed its commitment to continue to provide support to priority sectors as the need arises to support growth until the current upward pressure in price development abates. The committee therefore decided by unanimous vote to raise the monetary policy rate. 6 members voted to raise the MPR by 150 basis points, 4 members by 100 basis points, and 1 member by 50 basis points to 13.5%. In summary, MPC voted to 1. Raise MPR to 13%, 2. Retain asymmetric corridor of plus 100 and minus 700 basis points around the MPR, retain the CRR at 27%, but also urged the management to continue to use its discretionary powers to mop up liquidity where they find it, to ensure that we maintain a very tight monetary liquidity in the system. And 4, retain liquidity ratio at 30%.
During the question and answer session, journalists sought to know whether the MPC was following a global trend in its decision to raise the interest rate, as well as the impact of that on the economy.
Thank you, Director. Good afternoon, Governor and members of the MPC. I just have one question. The historic change to the MPR, first time in 2 years. Why is the MPC deciding to alter the rates now? Is it more of a local environment, or you're following global central banks? Thank you, Governor.
Good afternoon, CBN Governor. My name is Issa Abdullah from the Telegraph newspapers. Nigerians of late have been witnessing acceleration in market price and inflation. What will MPC do to rein in inflation? And secondly, the adoption, the increase in the lending rates, what impact will it have on GDP?
Governor, members of the committee, my name is Sunday Michael Ogo. I write for Daily Trust. Recently, we learned that JP Morgan had delisted Nigeria from the emerging market list, especially at the time where we need all the dollars available to support our local situation. What is your reaction to this development? Thank you.
That's the much we can take. Governor, sir.
Nigeria has not been delisted from any JP Morgan bond index. We have the report here. Page 10 of it, I won't bore you with it. Those of you can go online. You can go online and read it. Page 10 was specifically devoted to Nigeria, and it was very, very clear the reason why Nigeria's rating was moved from overweight to just market weight. I don't think it is important for me to say what they said. If you read the report yourself, you will see that it is not as a result of certain failure or failings on the part of the Central Bank of Nigeria. What is important is that, at least one thing that they have said very clearly, is that Nigeria had been left as an overweight country because they felt that as an oil-producing country, a creation to reserve in the midst of an increase in crude price should result in a creation in reserve. And since they are seeing that this is not happening, that is the reason Nigeria's weight has been brought from overweight to market weight. But I think the other details are there in the report. From Nancy and New Telegraph are basically related to the main reasons for today's meeting. On inflation, MPR, why the central bank decided, after almost about 2.5 years, to change its stance from just being somewhat accommodative by saying that yes, we want to play soft because we're trying to see a gradual moderation in inflation rates, while at the same time we see to how we gradually boost growth, output growth in the country. However, you all the communique has spoken very extensively about the concerns about the global rise, inflation, and price levels. You all would have seen that the price of crude quite unexpectedly has been at above $100 per barrel. In fact, Nigeria's Bonny Light as at yesterday when we started the meeting was about $116 per barrel. And what this means is that the basic plat, what is called the standard pricing indicator, means that yes, whereas crude prices have gone up per barrel, but at the same time, the cost of refinery and ultimate price of the product at the pump is at the station. The pump price at the station will naturally have gone up. This is a global phenomenon. And I was watching CNN a few days ago, and one of the analysts was talking about an incredible distortion to financial markets in the United States. And I said, yes, well, welcome to a situation whereas inflation is rising to unprecedented levels in the US and other economies, growth is also coming down. And if you must tackle inflation, prices, and at the same time you want growth, then you know that you are faced with some compelling dilemma as to what to do. You like to see inflation come down, but at the same time, you want growth to go up. But to achieve this, you have to take decisions that are in opposite direction. And that brings to bear as to what type of skills do you have you put in place to ensure that you're able to manage these two in a way that you maintain a balance where you say moderation in inflation and at the same time you grow your economy. For us in Nigeria, you would have observed that in the last 2.5 years, what we have been saying is that we want to pursue a policy of price stability that is conducive to growth. And that's why somehow we have used our development finance intervention facilities, which has actually yielded positive results and helped to drive growth in our economy. We've used that to drive growth, while at the same time we'll try as much as possible to maintain a hold position while looking at the optimal level of liquidity in the industry to be able to moderate inflation at a level that does not hurt the growth and the economy of our country. But with what we have seen globally, either in the area of supply chains, in the area of increase in price of petroleum products and the rest of them, we have seen an aggressive growth in inflation in Nigeria between March and April of 2022. And the forecasts from our statisticians, both in CBN and the NBS, as well as our colleagues in research and monetary policy, is that unless something drastic, some drastic or significant actions are taken, that it may be difficult for us to really rein in inflation if we don't do something immediately. And that's the reason we felt, okay, for monetary policy, like I said, three things. One, use development finance tools to drive growth and see to how you can use those same tools through the granting of facilities at low interest rate, 5%, 10-year loan, 10-year loan with 2-year moratorium and single-digit interest rate, to see how you can use that to drive agriculture and manufacturing output to a level where it can even be seen to be positive on prices, thereby moderating prices. That is one. So what do you achieve with both that? You achieve output growth, manufacturing output and agricultural output through our various interventions in targeted credit facilities and SMEs. You can boost consumption expenditure and through that boost growth. But by the fact that you are boosting manufacturing and agricultural output, what you find is that we are also positively impacting prices, which also is effectively inflation. That's one approach we thought we should adopt. Another approach we're adopting all along is to see given the MPC give management the power to say, listen, use your discretionary power to manage the level of liquidity in the system to a point where you think that it does not hamper, create serious problems for inflation. But with what is happening globally on prices and output, and then we've seen an aggressive a 90 basis points increase in inflation for us, and with an expectation that it may even further continue at the aggressive rise, meant that we needed to bring into the football field now MPR, to further say that we need interest rates to move up, particularly in the non-priority sectors that we are looking at, that there's a need for interest rate to be signaled and a little bit more aggressive, because you would have expected that perhaps would have done a signaling, but MPC felt that a 150 basis points would be necessary to really show that we want to truly tame inflation and rein it to a level that we think it can begin to reverse rather than continuing to go up. So what are we doing to make sure that this does not affect, because of course you will expect that lending rates will go up. Yes, lending rates will go up to the non-priority sectors. We're not going to deny that, but at least to our priority sectors where we remain committed to, MPC has told management, continue your development finance activities at single-digit interest rates for 10 years loan and 2 years moratorium, whereas what we can call the non-priority ones, if they go up, then we should be able to use that as a basis to see to how we're able to tame inflation to a level that we think is comfortable. I think what is important here is that this decision has been taken because we felt that there may continue in the next couple of months to be an aggressive acceleration in inflation. And we think there is a need to take some drastic action to reverse it. If we're able to see a reversal, perhaps we can begin to say, yeah, we're returning to what we can call the normal periods when we're looking at using CRR to moderate inflation, and at the same time using our development finance to really push for growth. It's not an easy task, and I'm sure you can see the way I'm trying to explain it, but I think trying to understand the mindset of Monetary Policy Committee members at this time is very, very important, that we thought we needed to really speak what is true about our economy, about what is happening globally, and then see to how we can make sure that we tame inflation, which is our core mandate, and at the same time we support growth in the other direction so that Nigerians can see prosperity effectively.
If someone calls or sends you a message that you have payment issues with your bank and requests that you reveal sensitive information, end the call and don't click. It might just be a scam. No bank will ever ask you for your personal identification number, PIN, mobile banking password, or your card verification code, CVC. Scammers always sound genuine, but don't fall for their bait. Don't respond to phony emails or SMS, and don't click on any dubious links. Even if the other party calls your date of birth or your BVN, don't give them your security details. If you suspect there's an issue with your account, the safest thing to do is go to your bank or call the number provided by your bank directly. Protect your bank details so no one steals your money. This message is from the Central Bank of Nigeria, CBN.
Thanks for staying tuned. You're watching From the CBN, a weekly program that brings to you reports and expert analysis of the actions, policies, and economic initiatives of the Central Bank of Nigeria, CBN. The 44th CBN Senior Open Tennis Championship held last Saturday at the MKO Abiola Stadium, Abuja. Mary Love Edwards and Nonso Madueke won the women and men's singles titles respectively. In the wheelchair category, Alex Adewale won the men's single, while Kafaya Tomishore defeated Oluwakemi Shegun to win the ladies' single crown. Here are the highlights of the sporting event.
Indeed, the CBN management is very impressed by the level of competition among the players and will continue to sponsor the Senior Open Tennis Championship to ensure it remains established as a major sporting event in the calendar of NTL. Let me also reiterate that the CBN remains passionate about the youth of this country and will continue to seek ways to empower and impact on the lives of its extremely young population, and the role of sports in youth development anywhere in the world cannot be overemphasized.
Women wheelchair, please get ready.
The Central Bank of Nigeria's Development Finance team went on an on-site monitoring exercise of some RSSF DCRR-funded projects in Lagos State. We'll bring you details in our subsequent package from the CBN. Get your unresolved banking issues across to the CBN Consumer Protection Department using the email address cpd@cbn.gov.ng. Attach relevant documents. Call the CBN Contact Center on the phone line +234 700 2255 226. Local call rates may apply. Send your inquiries and comments to the dedicated email address from the cbn@gmail.com. Follow us on Facebook, YouTube, Instagram, and Twitter for updates and uploaded episodes of the program. We invite you to join us again next time. I'm Muliyemi Sidada. Stay safe and bye for now.